is you kind of said it came across your desk. So I was curious, what exactly does that mean? Where are you working with one broker specifically who brings these to you, or are you out like hunting for your properties?
Yeah, so you can take a lot of different approaches with finding deals. The approach that I've taken is to work closely with brokers and property managers. So this Vance Street deal came to me from a property manager that's also a broker, and I was working with him on scouting some properties here locally. And in one of those trips, he said, "Hey, by the way, I have this other deal that seems to be going sideways. It needs somebody with the ability to close all cash. And is that something that you'd be interested in?" And so that's what kind of started it. So you know, it wasn't something that directly came to me, but when you're out there talking to people, showing that you're active and interested, these things tend to kind of fortuitously come up. And so that's how this one did.
Very cool. And is that what kind of caught your attention the most? Is that it needed a very specific circumstance to get done? The fact that you knew you could have access to the private capital to actually get this deal done. So once you kind of had your hook in it, what from there continued to make the deal interesting to you?
Yeah, I think nowadays when properties are marketed via brokers or they're officially on the market, I haven't seen any that have really been good deals. The market's just been overheated
Mhm.
and people are willing to pay for a lot. So almost anything that officially comes through with an OM and is on market, it's so far away from the number that I would be willing to purchase it at that they're basically, I just don't do anything with them and I let them go by. So in this one, so each deal kind of needs to have a story to make it compelling, to know like, oh, this is in fact unique. It's not just something that 100 other people are going to look at and 100 other people are going to be able to act on. So yeah, this one was appealing in that it had a wrinkle that I felt like I could work around. So that's what initially got me hooked. And then, because it had this wrinkle, because it was off market, meant that when I did my underwriting, it penciled out pretty close to something that worked for me. And my underwriting tends to be a little on the conservative side, and it still penciled out to be pretty decent returns. So that rarely happens. So when I saw the numbers come out that closely, it's like, okay, we got something here, and let's dig a little bit deeper and make sure that it's what it appears to be on the surface is something that I want to take to close.
Right. So you had mentioned you have like different phases of underwriting. So when you're saying pencil it out, it's like that first pass of underwriting. So do you underwrite it with that, I think the asking price was the 650. So did you do all your underwriting with 650, or did you kind of assume you were going to be able to get that down?
I will start with the asking price,
Mhm.
but I'll start with the asking price when I'm entering the actuals to get a sense for, okay, this property is earning, has certain NOI. This is their ask price. Thus, this is the cap rate. Is that kind of in line with what the cap rate is for these types of assets and wherever the area is? So it just gives me an initial take on the mentality of the seller and how realistic they're being or how aggressive they are or are not being. So I will put that in, but then when I go to look at, okay, what does my underwriting look like and what do I think I can do with this property based on, what I know to be reasonable approximations and expense ratios and whatnot. When I do that, I'll basically ignore the asking price. And I'll be like,
Okay.
okay, I know I want my returns to be, call it a 12 to 18% IRR range, certain cash on cash, like 6% plus cash on cash. What does the purchase price need to be for me to hit those returns? And then I'll look to see how close the two are. And so if they're within, 10% of each other, maybe 15% for certain asset classes, then it's close enough for me to dig a little deeper.
So because I saw that your actual offer was a little bit lower than what their asking was. When did you come, like, in what part of the process did you come up with your actual offer? Was that as part of the initial underwriting? You're like, okay, there's something here, but I'm going to put in an offer for, I think it was 612. Or did you offer the asking price and then in some point in the due diligence you found something, you're like, actually I need to drop it down a little bit?
Because a lot of my assumptions are on the conservative side, my approach tends to be to to aim low or
Mhm.
aim high, depending on how you want to think, but aim for that lower offer price right off the bat versus try to retrade later.
Mhm.
Okay. So I try to just put a very realistic but aggressive offer in. And if we have to negotiate up from there a little bit, we can. But I do not take the approach of trying to give an offer that's as close to the ask as possible with the mindset of, all right, for this to work, I'm going to need to kind of hammer them and chip away at them during a due diligence process. I'd rather know going in that it works based on the merits and based on the projections. So that's kind of the approach that I take.
Yeah, it's more of a good faith process if you go in with that type of mentality.
Yeah, it's a pretty small industry. It's a small world, and so with brokers, with sellers, you definitely don't want to be known as somebody who's always coming back to the well to ask for more and more off. So, and I just like that approach better. It matches more with my personality. Just like to be upfront, tell people where I am. If they're not at the same place or we're not close, then I don't want to waste their time, and I want to respect their time as well.
Right, exactly. So would you be able to bring up the actual spreadsheet? I'd be curious to know like exactly how you came up with your um what you actually offered for the property.
Sure. I'm going to share my browser. Let's bump up the font. Can you see that pretty well?
Yep.
Okay. Um, okay. So where do you want to start as far as how I got to the offer price?
So let's see. Um so obviously you have the 650, and then if you go down the marketing package, that's all the actuals. Um so what in the marketing package did you identify as, something, this is something, it's close, but I need it to bump up a little bit to be something that works for me? Like what in the marketing package made you decide that you wanted to make the deal work a little bit better for you?
Well, so in this one, there was no official marketing package.
Okay.
So I was really going based on solely the current rents. So over here, where I put the is where I put the existing rents. So I knew that there were 12 units. They were averaging about 650. So all that goes into a gross income. I put vacancies, what I thought would be kind of for a property of this type, a little on the high side, but I thought, if this was a manager that was not kind of professionally managing, that it's possible that the vacancies would be a little on the high side. I put in a standard expense ratio, 45%, which is, pretty fair for a smaller property. You can certainly get much lower than this with good management, but I didn't want to assume that. And I came out to what I thought their actual NOI would be, which is around 45K.
So when you
Um,
said that they really didn't have any numbers for you to work on, like they legitimately really did not record any of their expenses. So this is all just you filling in kind of rules of thumb.
exactly. And, you'll see here in my offer, the offer side, I went through and I line by line filled in realistic expenses for each item. I didn't just go based on a 45% or whatever X percent estimate.
Mhm.
Since I got deeper in this one, I really went line by line. But for the marketing package, we're just going based on estimates. And again, it's not hugely important that you nail what the actuals are because so much of it is, unless it's a fully stabilized property, but I'm
Mhm.
not buying for the condition of the property as it stands today. I'm buying for what I think I can do with it in the future. So again, getting the actuals right on a property like this where they're not officially recorded, it's more for just my estimations and just kind of understanding where the seller is. It didn't directly factor into the offer that I would have made. Um,
Gotcha. So then what actually brought you to the amount you finally offered?
so I went through and um, after speaking with the property manager, see over here, I entered what I thought the market rents were.
Mhm.
So we think that rents, which are now going for around 650, market rents are much closer to 800, and this is still a conservative estimate. We think 850 might be very realistic, but for the purposes of estimation, we're gonna take the low side of whatever range we think is possible. So we think 800. That's $150 a month in lost to lease, lost to market that we think is sitting there that's ripe for the taking.
Mhm.
So with a property that has $800 rent months across 12 units, that comes in over here to be our gross potential income. I kind of put my estimates for vacancies here. These are still very high estimates. 14% total vacancies is a very conservative number. This
And was
is
that based on like the environment with like coronavirus and?
this was pre-Corona when I started looking at this, and we'll talk about maybe Corona in a little bit, but this is based on the asset, the class of the asset. It's probably a C plus, so it's well maintained, but it's definitely workforce housing, and it was built in I think '69, so this was a slightly older property. And it's in, it's not in the middle of Raleigh or in the middle of Durham. It's an outlying area. And so they just don't have as strong of fundamentals. Now it's a very fast growing area. Mebane has 2% population growth year over year, but it's still a small town. So it's more susceptible to disruptions. And so that's why I chose kind of conservative 14% to, economic vacancies. So kind of my vacancies. So we've got income, right? Based on what we think the market will support, 800. We have vacancies based on what I know of the area and of the property. And the other item is the rent, the expenses.
And this
so
was
kind of
in due diligence, you actually went line by line. This is at like the product of talking to insurance brokers and
this
doing all
is
the
pre-due diligence. Okay, so this is me determining what the right offer price is.
Okay.
Okay.
Right.
So, but I still know enough to go through line by line here. Like I can look up what real estate taxes are. I can apply a multiple to that because I know they get reassessed every couple of years. So I don't want to put in my estimate what the owner paid 3 years ago. I want to know what I'm going to pay next year or the next 2 years. And all these other items are easily estimated items.
Mm-hmm. Is that the rule of thumb over to the right? Is that kind of what that is for? It is for estimating the expenses?
This is kind of, these aren't necessarily my estimates, but they are what was provided with Michael Block's SDA, the Syndicated Deal Analyzer, which is a spreadsheet I'm using here. So if you have zero knowledge of your area of managing certain properties, these are good starting points. I find them to be high.
Mm-hmm.
So like I know insurance wise, most of the time my insurance quotes come in under. Most of the time my repairs and maintenance have come in slightly under. So, but if you don't have any specific knowledge, you should probably use these rules of thumbs because they'll protect you to the downside.
Right, especially if they skew to more conservative.
Yep. And so I put in all my expenses. I double checked that the expense ratio doesn't seem crazy. It looks like my estimates had this at around a 45% expense ratio, which is realistic for a property of this size. So I'm like, okay, I feel good about that. I wasn't too optimistic. And then I put in my debt assumptions. And so that brought me to, you can't really see it on this sheet because this is like the offer column is your fully stabilized view. Mm-hmm. But based on these numbers, I went into the summary tab and kind of looked down at what my return would be. And it's around that 12 to 15% return area at this purchase price. So if I had left this at a 650, which is what the ask was, and I went into the summary tab, the returns are pretty low. Mm. So I'm like, okay, but it feels like there's something here. A lot of times I'll plug in first pass numbers and I'll get negative returns because of my assumptions are pretty tight. So when I started playing around with the asking price, I was like, all right, well, how low would this have to go to get a decent return? I put in 600 as the ask, went back to the summary, like, oh, okay, it didn't take that much reduction in price to really juice my returns. And so it felt close enough that it was worth making an offer. I think my initial offer was around the 600 point, and then we kind of settled on where we finished, which was 612.5.
So it was after a little bit of back and forth that you landed on that number.
Yeah, it was a little bit of back and forth, but it took place over 2 to 3 months because again, this property was already under contract with another buyer, so that we had to wait for that to run its course before I could engage in good faith. And so there was an extended time frame with which to have, which ended up being a pretty quick negotiation period.
Mhm. So at what point did you actually reach out to your private lender? So was it, because obviously you knew that was a very key factor in getting this deal to come to fruition.
Yes.
So at what point did you actually present it to him? And then how did you come up with the terms?
So when I was originally looking at this deal, most of the things I look at are with the intention of bringing in investors that I know that are wanting to move into this asset class. And so a typical structure is a 70-30 member manager split. And you kind of have syndication terms, like there's an asset management fee, there's an acquisition fee, or there's a whole bunch of fees and returns built in to go to me, the managing partner, when I'm taking investment for others. But when I did the numbers, the deal didn't work because it's too small. There's just not enough meat there to start slicing it up between lots of different people. So it was at the point where I saw this deal couldn't support outside investment or multiple investment interests. And combined with the fact that I knew that some of my investors were not out for just sheer 15, like pure returns, equity multiples, like that wasn't their priority. Their priority was more in the capital preservation. That was their priority, was capital preservation. And so they were more interested in like, hey, if I could get a 4, 5, 6, 7, 8% return, but it's highly securitized or collateralized and first lien, right? It's a very safe thing to do.
Right.
They're all for that. So I combined with what I knew the priorities of some of my investors were with what this deal could support. And at that point, it was clear to me that it made more sense for this to be for me to bring in debt versus equity.
So then at what actual point did you present it to that particular investor? Did you?
It was before I made an offer. It was like, so once I figured out an offer price, what the structure needed to be, it's like, okay, at this offer price, assuming debt, private money, this is a good return. It supports the mortgage payments easily. So it's a very conservative investment. Then I went to them to make sure that that was a business model that they were supportive of before I made the offer. Because without the private money, this deal didn't work for me. So I wouldn't have made the offer.
Right, that makes sense. So then how did you decide on the structure of the loan? Because I believe the numbers were 3 years interest only, and then the amortization started, it was a 30-year amortization, but that started in year 3. So I was wondering exactly how that works and what about that deal structure made it attractive to you.
Right. So I pulled up the P&L view here, which is really the source of truth for these deals. So you can have your calculators up front that kind of give you a sense of once everything is stabilized, what your cash on cash looks like and other metrics. But if it takes you 5 years to get there, that obviously meaningfully impacts what your total returns will be and what your return profile is. So I like to, once I kind of enter the high level numbers, really dig into the P&L on a year by year basis to understand the performance of this property. So when I went to the P&L and I made some adjustments specifically for the times that we're living in and the whole COVID stuff that's happening and just really reducing expectations around some of the concessions, loss to lease, bad debt that we will certainly see more of. We've already seen a slight uptick, and it's multifamily's been performing pretty well so far, but just wanted to be really conservative about my expectations of, yes, I think I can certainly get people into those apartments, but are they going to be paying me during this time of economic hardship? So I really ramped up what I thought the economic vacancies would be, right? So, and I also extended the time that it's going to take me to get from current rents to market rents, right? You can't just go in and on day one raise everybody's rents by $150. You have to wait till current leases expire and so forth. So there's like this rolling period, this rolling approach before you get everybody up to market. And even in normal times, that can take 2 years. So what I did is I said, look, in year 1, 2020, I'm probably not going to be able to be very aggressive. I'm going to want to prioritize high occupancies versus making sure I'm pegged right at market rents. So I basically said, look, it's probably taken me an extra year to fully implement my business plan and get to a stabilized property than normal time. So I'm going to go from year 1 to year 3. And here we see year 3 is when I'm projecting that we're actually going to hit our target market rents. And so these are the years where I'm going to have less top line income, and expenses for the most part will be the same. My debt's going to be a line item that's mostly fixed. And so for that period of time, the most beneficial structure for me for that debt was for it to be IO. So to be as least burdened debt as I could have in that 0 to 3 to get to stabilization. And so that's why that IO 3-year period made sense for me.
And then I believe, so the term, it was also like was it a 5-year max for the loan, if I remember correctly?
So the loan, it's a 10-year balloon.
Okay.
Yeah. So it's a 30-year amortization, but a 10-year balloon payment, which is, most commercial loans have 5, 7, 10 years, sometimes 12-year balloon payments.
Mm-hmm. So then, and I'm just not sure exactly how the interest only versus amortization works. I believe in the actual like mortgage tab, the amortization starts in year 3. So that 30-year period starts in year 3.
That's right. So the way this mortgage is, or at least the default, and this is something you have to confirm with the lender to make sure you're on the same page, is that, yep. So for the first 3 years, you are paying no principal. You're just paying whatever the interest rate was, and the interest rate here on this loan is 6%. Mm-hmm. So you're only paying 6% on a monthly basis of what the loan amount was is $3,050. So you can pay $3,050, but you've got no equity on that loan. And so at year 3, that's when you start actually paying down principal. Mm-hmm. Okay. So you see that this column right here is what your principal pay down starts to look like.
Right.
So, if you paid off the loan 3 years from now, right at the end of its interest only period, you'd still have the full loan amount to pay.
And so that's what makes it more
pushing
attractive.
back that.
Yeah, that's what makes it more attractive to the lender in that case. The reason why they would support interest only, because they still get that full value of the loan.
I mean, where the lender makes their money is on this interest, right? The loan pay down part, that's not money in the lender's pocket. That's just paying down the loan itself. Right. So as long as the lender is getting their interest, that's what their profit is the interest. So to have an IO period of 3 years, and you can get IO loans that are 10 years long. Mm-hmm. But that's a different model, and it's a little bit more risk because you're using higher leverage. Right. But to the lender, these small IO periods, when matched with the right business plan, they can make a lot of sense.
And speaking of business plan, I saw you were factoring in a sale at year 7. I was wondering, what kind of made that the strategy in your mind versus like something that you'd want to hold forever?
So I'll underwrite by default for 7 years. That's just a good it's a long enough period of time that you have a lot of flexibility in when you want to sell. Mm-hmm. So I'll underwrite by default for 7. This particular property, that's just basically a personal purchase I'm the 100% owner of. I will evaluate as the years go on, like once it's fully stabilized. At that point, I'll evaluate okay, is this performing really well? What is the market value? How much equity do I have locked up in this deal? If it's $500K in equity and I can do more with $500K of money than what this property is returning, like the return on equity for me, then I'll look at others and maybe look at liquidating this. Mm-hmm. If my priorities at that time are pure cash flow and this thing is just doing really well on the cash flow front, then I will hold it. So it's not that just because I underwrote for 7 just as a default to kind of get a sense for what the returns are does not mean I'm committed to that. Now, mm-hmm. your loan terms will dictate more the limitations of your business model, because my loan terms are balloon payment after 10 years. So hopefully well before that 10-year period, I'm either going to need to refinance or get a new loan or something like that. So that's what you really have to keep an eye out for is the loan when you're looking at what do I need to, how long am I going to hold this thing for?
That makes sense. So it's not something you tend to decide unless, is that a difference between something you're holding yourself versus something you're looking to syndicate? Like if you were looking to syndicate,
Yeah.
would you have to have that business plan all lined out right in the beginning, or do you still have a little bit of flexibility?
Yeah, when you're syndicating, or whether syndication is the vehicle or not, when you have a lot of other investors, you want to be a lot more concrete with what your exit strategy is upfront. Doesn't mean you can't have some flexibility, but because there are varying interests amongst multiple people, you're going to want to know that you have buy-in from them upfront about what your exit looks like, however many years it is from now. So because this is just my personal property, this one, that like I'm the only decision maker, so I don't need to agree with myself right now as far as what it'll be. I know there are a couple different options that I will probably have when this comes due, but I know I don't have to work with somebody else, so that's something I can make. It's a decision I can make in the moment. If I had investors, they may know that they want to do something with their money in 5 years, but no more. Or they have other constraints, things like that, or they just want to know that they're continuously cycling their money into bigger and better, higher quality assets. So that's why it's more important up front, if you have investors, to really agree on what your exit plans look like. And it can be more than one exit plan, but you want to get buy-in there. And that's not a formality I had to do with this one.
Right. So then the other option, other than selling it, would be to do the refinance. Um, and then, is there a typical optimal time frame for a refinance? Obviously, again, it's dependent on the loan, but as I see, you know, from bigger deals I've looked at, people tend to put the refinance right around year 3. And is that usually just because that's what the stabilization period for the loan, or is there any other factors that usually make it around that 3-year mark?
Most of the time, sponsors are looking to refinance at least 75% of the money that was put in. And so a lot of the business plans, that 3-year period is time for them to implement whatever their value add strategy is and
Mhm.
get it to a stabilized point. So if you think about the value of the property as a curve, like a stabilized property just kind of goes up just very linearly based on market rents increasing. Forced appreciation or value add business plans, in the beginning, you're taking from low rents to higher, and it's like a curve like this, because that's where all the value increase is coming from, is in that initial period of time where you're investing into the property and repositioning it to get higher rents. That's a
Mhm.
huge capture of value. And then things kind of stabilize. So because most of the value capture was up front, once the majority of that has been in place, that's probably the ideal time to refinance at that higher number, pull out 75% of that higher number, which hopefully equals almost 100% of what was put in originally. So because the inflection point of the value curve there tends to happen once the business plan is stabilized, which tends to be around 3 years. I think that's why that's the number that you see a lot of the times is the 3-year mark. But just because maybe something has a refi at year 5 or year 2 doesn't mean there's something wrong with it or it's a sketchy deal. All of these business plans are different. The properties are different. How long it'll take to get there are different. So you just kind of have to pair the business plan and what is actually realistically possible with your financing and with when capital gets extracted from the deal.
Right. That makes sense. All right. So I was wondering about just the general scope of this entire process. Um, how long, I know this was a little bit unique because it was under contract, but like how long did each kind of piece of this come together? So, if you think about finding the deal, doing your initial underwriting, um, putting in your initial offer, and then the due diligence period after that. It's like how long and how much effort goes into each piece.
Everyone is different. This one again was kind of already under contract, so I had to kind of wait a little bit. I knew about it. I did some initial underwriting up front, but knew I just had to wait around and be patient and stay in contact with the broker about how the deal was going. Try not to be too annoying, but letting him know I'm still interested. So that this one had a kind of a long, slow lead-in period,
Mhm.
and then And then when the original buyers fell through, then I stepped in, and from there it was very quick, because part of the advantage that I was trying to communicate, trying to bring to the table was, hey, I have an ability to close quickly with less hassle than any other buyer. That's why you should go with me, even though the price might be lower than what you think you can get on the market. So I was trying to make that my competitive advantage. So I was trying to move very quickly. So it was a long lead in time, but then at the point of, okay, let's talk about price, go back and forth once or twice, nail on the price, that to close. So we actually did a 30-day close, which is very, very quick when you talk
Especially for
about
multifamily.
commercial, right? Yep. And we were able to do that. A lot of times the length of the close is the two main periods you have are due diligence and then your financing. So because my financing was non-institutional, it was private, and I felt like I had a good relationship with this lender, I could move quickly on that front. There wouldn't be a lot of hiccups. We were on the same page. We had kind of talked about this up front. I felt like that could go quickly. And then on the due diligence side, I had already been out to the property a couple times. I had talked to the broker about their knowledge already of the property. So I felt like I had a little bit of a leg up there. I felt like I could move pretty quickly on the due diligence side. So from accepted LOI/contract to close was 30 days, and we hit it, and it actually went pretty smoothly. So that's not going to be typical, but that's how this one went down.
That's pretty impressive. So as a new person, trying to break into the industry, I was curious, like if you had any just general advice on what skills are most important in each step of the process. So, obviously underwriting is, practicing underwriting and being able to dive into the nitty gritty and be able to make projections and things. But what, are some other skills that you would suggest a new person hone in on to become successful at going through this process?
You need a couple different things for a deal, right? You need experience, you need capital, you need time. And so I would look at, and there's a talk that I want to give at a conference that's coming up here in a couple months that will really kind of make this a very structured approach to thinking about what does my path to multifamily look like, or my path to commercial real estate and even real estate in general. So my thoughts aren't fully fleshed out or highly structured yet, but I know there's a scaffold in my head that I know I want to capture on paper and really make very clear. But if you think about those three needs that you have to do a deal, it really depends on what resources you have access to, what your personality is, what your strengths are, what you enjoy doing, as far as what skills you need to be working on. So if you think that you want to be able to take down a deal yourself, well, you're going to need to do all the things. You're going to need to analytically be good, underwriting and estimating and analyzing deals and trying to identify strengths and weaknesses and where those points of leverage are that's going to make or break the deal. You're going to need to, unless you have your own capital, you're going to need to be able to network and talk with other investors and educate them and come across as trustworthy and a competent source that they would actually give money to and feel comfortable that you're going to be a good steward of their money. So that's personal, it's interrelation or interpersonal and relationship based skills, like all those types of things. And then as far as like time and experience, are you willing to invest the time? How are you going to educate yourself to become confident, to become knowledgeable, to be able to both execute a deal and also management, right? The closing and the acquisition, it's like, that's the start of the race. Yes, it's a lot of work. There's a spike of work in the beginning, but congratulations, you've committed yourself to 5 to 7 years of whatever this thing is going to be. So that's all about then the operation, whether there's heavy rehabs, what does your team look like there? Is it repositioning, just rebranding, all sorts of things that go into running the apartment as a business. And so the operational asset management side of things is also a kind of a slightly different skill set. So those are three broad buckets of skills you need to have. And as a newbie, if you're looking, and depending on where you want to be, you might need one or all of those kind of classes of skills to start working on.
And that actually, the operations brought me back a little bit. So for your property, I know you said you have a property management team already. I'm assuming it wasn't the people originally managing the property. So how did you connect with them?
Well, they were the ones that originally clued me in that this deal was out there, right? So they were our existing property managers on an investment, a group that I've worked with in the past has other investments in the area. They are the property manager on these other investments. So I was aware of him through some of my work with the other group. And so had started using him as I was looking out for properties of my own. And so that's how we built that relationship. So the property management kind of came with this deal. I absolutely could have chosen a different property management team, but this type of property is right within their current wheelhouse. So I was very comfortable going with them, and again had already established that relationship. So felt good about that.
And about the property itself, I think you mentioned it was mostly stabilized, like there wasn't much you have to do in form of renovation. You can do it organically. So what's your process of, choosing contractors? Is it more fall under the property management? You kind of give them the reins on that, and since they're clued into the area, they identify who they want working, or is that something you take care of?
It can definitely vary. My approach, like I know I value my time and I want to be doing more and more of these deals. So I want to be able to have a good team in place that I can manage without having to do any of the work myself, right? Or to really get into the nitty gritty project management details. So I'm going to lean very heavily on my project management team to use their vendor network and contractors they work with in the past, for them to know what level of finishes are appropriate for certain markets and things like that. So I'm wanting them to bring their operational experience and nitty gritty on the ground experience to the table. I'll hold them accountable to certain goals and KPIs, but I also don't want to micromanage what it means to hit those. So, and in the beginning, there might be a little more higher touch where I'm going to be out there much more frequently, confirming that work is done to a certain quality, and that, when we talk about this big plan, that in fact is getting implemented in a way that I approve of. But then once we have that comfort, once those expectations have been set, my goal would be to give them as much freedom as possible and let them execute.
And then that's why it's so important to do that due diligence in the beginning of the process and making sure that you have a property management team that is capable of performing to that level.
Yeah, I mean, your property management team can make or break the deal. You see, and I've experienced this with a single family that I have that I manage remotely. They're going to either make your lives easy and a cakewalk, or it's going to make your life hell. So, you as a manager of managers, you have to be prepared to hold people to expectations, but also let them go when they're not meeting it. And when you find a good one, that can really just make your life so much easier to know you have a trusted partner that you can hand assets to with a certain business plan, properly specified, that they're going to be able to execute on that. So definitely very, very important to feel good about your PM representation.
And then I think what I kind of skipped over in the beginning, but what about the area? Because you had mentioned that you had been keeping an eye on this area for a while and you were excited for the opportunity to actually get property there. So, what excites you about the area? What metrics and demographics do you tend to look for when you're searching different areas to invest in?
Yeah, so I do a lot based on net population trends, population migration trends. I feel like that you can always go deeper, and I do go to higher level of granularity. But as far as just a really clear indication of, does this area have long-term growth and trends that are going to support multifamily, I find that population growth is the clearest metric, the clearest single metric, right? If there are good jobs, if the area is affordable, if if the weather is tolerable by most people, right? If it has all these factors, general quality of life factors, more people are going to want to live there than not. Then are going to want to leave, and so you're going to see a positive population growth, which obviously supports multifamily. So in my area, so we're in North Carolina. I live in the Raleigh area. There's an area called the Triad, which is Greensboro, Winston-Salem. It's about 45 minutes to an hour away from Raleigh-Durham. So you have these two big metro areas with strong growth. Raleigh-Durham, certainly very, very strong growth. The Triad, national average to above, but very affordable and lots of other positive trends. You have these two areas here, and you've got Highway 40 that connects them. So it's like a barbell. You have this Highway 40, two big hubs on either side. And what we've seen in the last decade is all these areas in between, which 20, 30 years ago were just super, super tiny urban or suburban, rural is the right word, super tiny rural little towns, have experienced just a huge amount of growth because you can live in these areas, commute into the huge population and job centers of Raleigh, Durham, and the Triad, but
They're
get
more affordable and
more affordable, kind of a slower pace of life, not like Raleigh, Durham is New York City, but for certain people that they like a certain type of setting. So that affordability and convenience all along 40 in between the two bookends there has just seen really good growth, really strong rent growth, just all the fundamentals that you want to see. And so there's a cluster of towns kind of right in the middle, of which Mebane is one of them, that exhibit these qualities. And so this area is one that I've really been targeting for a while, realizing that as a smaller operator right now, I don't have the network. I don't have the capital to just be going in and playing with the really big boys that are fishing around in Raleigh, Durham, and the Triad, buying these massive complexes.
mm-hmm.
So my little wrinkle in the market are these, call it 20 to 70 unit apartments that maybe are not located smack dab in Raleigh, Durham, but are really close enough to be getting all the positive growth and positive support from the Raleigh Durhams without being right in there. And also, I'm one of a much smaller number of fish that are trying to kind of go after that. So that was my thinking. That's why I've kind of been focused on that area of 40 between the two areas, and why I was excited to see this one come up.
So when you're networking, that's what you're kind of projecting, right? Is when you're talking to all these different people, like how important is it to be, very specific in what you're looking for? You don't want to be so specific that, some people like will let deals pass and then not think of you, be like, oh, I don't think he'd be interested in this. Like, how do you bridge that gap between, being specific enough that people know what you're looking for without closing yourself off to opportunities?
So most operators, investors, sponsors, if you told them to write down a list of 10 things that they want in a deal, they could write down the 10 things that they want, right? It's in a great area. It's a B or A class. It's got 10% cash return and high appreciation, like all these wonderful things. And it's like, yeah, of course you want that. Like everybody wants those things. The issue is, how much are you willing to pay for those things? Do you have an ability to close on them, and what's truly important? So I like to really choose 1 to 3 things, probably 2 to 3 things that are important to you, right? Mm-hmm. So for me, I want properties to be in a certain, in a growing area, right? So I don't want 0 to lower than national average population growth in that area. I want to know that there are really long-term trends that are supporting the growth of that area, because I don't want to be fighting a tide that's receding, right? I'm one small property in this much broader ecosystem. So I just really want to know that I'm choosing a good area. And even if I make small mistakes over time, for the most part, this rising tide is going to lift my boat as well. So a good metro, a good geographic area is what I look for. That's why I focus. I'm in North Carolina, but there are probably 6 to 8 metros in North and South Carolina that have that type of growth that I would look at. We talked about North Carolina has Charlotte, has Wilmington as well. South Carolina has the upstate area of Greenville and Spartanburg. Charleston's really strong, Columbia as well. So like any of those metros.
And I would, letting suburbs around them as well.
Yeah, exactly. Yes. And you get the halo effect and these little satellite towns around it that kind of like what I'm doing here in Mebane are experiencing growth because of the strength of whatever their urban core is.
That was your first one.
So first one is the metro area itself. Also, given the capital that I have kind of pre-committed from a certain number of investors, I kind of know what my price range is. Mm-hmm. So I'll make sure that I'm not being sent $50 million deals, because I just know I can't close on those right now. So I think that's important too, to give people a sense of what size deal you can take down. You don't want to waste anybody's time, or I certainly don't like to appear bigger than I am. I like to be very realistic about what I'm, what I'm capable of closing. So the general size, or the general purchase price, kind of the cost of the acquisition. And then also, I know that I want there to be some meat on the bone, as they say, right? So I don't want just a fully stabilized asset. Those those never pencil out for me. There
Mhm.
has to be something that is going to meaningfully increase the rents. And that's actually the difficult one because everybody's looking for value add, right? Everybody's looking for that where there's some easy way to raise rents. And so what we've seen is that the price you're going to pay for value add has actually gone up over time as more and more people are looking at it. But there needs to be some unique story to why this asset can be improved. Has it been mismanaged? Is there some wrinkle that's preventing every other fish out there from trying to go after it? So between those three things, you can usually zero in on a few core areas to look at, and you have enough to give to a broker that will meaningfully narrow down the list.
Right, because if you think about the broker, there's a decent amount of players, like you mentioned, in the multifamily industry right now. So they have a lot of names, juggling around their head to making sure it gets in front of the right people.
And you have to stay in front of brokers too. They're human, right? So if you sent them an email a week ago, you're more likely to be thought of in their head as they're looking through their opportunities or as they're out there prospecting and something comes across, comes across their desk. So
Mhm.
you have to be clear about what your criteria are, and then also make sure that you're, establishing relationships and staying in front of the brokers.
So how often, like you call it touch points, so how many touch points do you try? Do you have an aim? Do you have a number? Or is it just more or organic? I haven't reached out to this person in a while. Make sure I email them this week.
Yeah, there are kind of tiers, as with any funnel or ways that you classify your relationships. There's probably tiers of them, right? So there's a couple brokers that I try to be in touch with in some form on a weekly basis.
Oh,
And
okay.
like I feel like we're actively engaged looking for things, and they've shown me that they're taking action and keeping me in mind, and so I'm definitely going to make sure that I'm doing the same back with them. Then there are some that I've had good conversations with, but maybe they just haven't been as active. Maybe they don't have a lot of deal flow, or for some reason I'm just not their first choice
Mhm.
to put an opportunity in front of. So I want to make sure that they know I'm being active, but I'm not in front of them every week, kind of annoying them. And then there are others that I've come across once or had a deal sent to me from, and I'll just kind of put them almost on a mailing list so that as I'm being active, as I'm acquiring properties, I'm letting them know and I'm showing them what I'm doing in hopes that I'll slowly kind of creep up. I'm like, oh, this flywheel equity place seems to be pretty active in this certain asset class, and kind of stay on their radar that way.
Right, like move up in their
Yep.
consciousness almost, so you get your name on the
Yeah.
top of the list. Um, so it's really interesting, and a lot of this also, because obviously I would start off with a lot smaller than where you're playing in right now, but I feel like a lot of this is very transferable to just real estate investing in general. You just
Yeah.
kind of change the players, or you change the terms that you're calling it. But what would you say is like the biggest strategic, or you know not necessarily strategic, but what are the biggest differences between, like, you know, being in the multifamily space versus maybe residential 1 or 2 units?
Well, I don't have a huge amount of experience in the small residential side. So I did single family remote burst style thing, which I still have in my portfolio. But that was a very unique experience. Uh, Commercial real estate to me feels a lot more relationship based, whereas residential, again, by my kind of superficial experience, seems a little bit more transactional, right? So
Mhm.
it takes less to come together to execute on a flip or a single family thing. It requires less support, less people, less time. You're just pulling in less. You can do more on your own in the single family space versus commercial, where even if you're the deal sponsor and you're 100% owner of the thing, to get that thing to close, to cover your liabilities, to get financing, just requires more people and a higher level of scrutiny.
Mhm.
So that's what it feels like to me at a very high level.
That's interesting. That, like, the commercial side of it is actually more relationship based. Like, I'm sure a lot of people have that kind of thought that it would have been the opposite, but that completely makes sense, that there's so many different people that you have to work with. And just like you said, how most deals come through brokers, you know, pretty much anyone can send out a couple letters and they might be able to find something on their own. Um, as far as residential real estate, but I'm guessing that wouldn't really work as well in the commercial realm.
Certainly not anymore. Like there was a day when going direct to seller had much higher success rate, but multifamily commercial has been so hot recently that the space has just gotten really competitive. So it's much harder to stand out in that way, at least from what my estimation of it. And to be honest, I have not put a huge amount of effort in trying to go direct to seller. So that maybe that's something that there is an opportunity, and I'm not properly taking advantage of it. But my sense from talking to others is it's just a really, really tough space to compete in.
Right. Thank you so much. I really appreciate your time in going through this.